What is payroll tax? In this video, you will learn who is subject to payroll tax and what makes up the payroll tax calculation. Let's consider who is responsible for payroll tax. Taxpayers refer to all employers and self-employed people. These include the Bermuda government, exempted companies, banks, local companies, partnerships, self-employed persons, consultants, schools, churches, charities, and any other entity or person engaged in business, even if the services are provided online. In Bermuda, payroll tax is a two-part tax. Part 1 is the employer portion, and Part 2 is the employee portion. Both portions combined represent the total tax owed per quarter. The employer withholds the employee portion and submits it to the government on behalf of each employee. Part 1, employer portion, plus Part 2, employee portion, equals the total quarterly payroll tax. Let's look at each part in detail. The employer portion of payroll tax is a flat rate which is applied to the total sum of the quarterly remuneration paid to every person working in the business. Taxable remuneration includes any amount paid in cash or in kind up to a maximum of $1 million Bermudian per person per fiscal year. This means that if a person earns $1,001, the extra dollar is not taxed. Remuneration refers to salaries and benefits, such as health, pension, vacation pay, bonuses, and other perks. Section 7 of the Payroll Tax Act 1995 provides a comprehensive list of the various taxable benefits. Visit www.bermudalaws.bm to read or download a copy of the Act. The following table represents the employer portion tax rates. These rates range from 0% to 10.25% depending on the category of the business. Pause here to view all the rates for the year 2023 to 2024. Otherwise, visit www.gov.bm/payroll tax to view the relevant rates for other years, since rates are subject to change. The employer portion tax rates. As shown by the table, the Bermuda government, schools, churches, charities, and concession taxpayers are levied 0% for the employer portion. However, other taxpayers with annual remuneration which is less than $200,000 per annum or less than $50,000 per quarter pay at a rate of 1%. Study the table to determine which employer portion tax rate is applicable to your business. The government, schools, churches, charities, and taxpayers approved for concessions 0%. Employers with employees in special situations, see Section 9 of the Payroll Tax Act 1995, and self-employed farmers and fishermen 0%. Taxpayers with annual payroll less than $200,000 or less than $50,000 per quarter 1%. Taxpayers with annual remuneration of not less than $200,000 and not more than $350,000, and the Bermuda Hospitals Board and the corporations of Hamilton and St. George's 2.5%. Taxpayers operating a restaurant or hotel with an annual payroll of $350,000 or greater, or with a quarterly payroll greater than $87,500, 5%. Taxpayers with annual remuneration of more than $350,000 and not more than $500,000, 5.25%. Retail establishments with annual remuneration over $500,000 and whose primary business is the sale of fashion, shoes, jewelry, and perfume, 6%. Taxpayers with an annual payroll greater than $500,000 and up to $1 million, 7.5%. Taxpayers with an annual payroll greater than $1 million, 10%. All exempt undertakings are taxed at 10.25%. We can see that the higher the sum of total remuneration for the entire company, the higher the employer portion tax rates. Now, let's look at the employee portion. The employee portion of payroll tax must be calculated separately from the employer portion and must be calculated for each person based on individual salaries and benefits. Everyone is taxed on the employee portion, including self-employed people. The employee portion of tax is calculated at progressive rates. The first and most important point to note with progressive tax that it is not a single tax rate. Instead, progressive tax is a series of increasingly higher rates which are applied to different portions of a person's estimated annual salary, referred to as estimated annualized remuneration. The portions of annualized remuneration are separated into bands, and each additional dollar earned is only taxed at the rate of the band in which it falls. Annualizing a person's salary means to multiply the amount received at a pay period by the number of pay periods in the year. For instance, a person who gets paid $1,000 a week has an estimated annualized remuneration of $52,000. This is calculated by multiplying $1,000 by 52 weeks. The estimated annual remuneration is then taxed according to the tax bands. If a person's salary fluctuates, then we simply determine the average and use that average to calculate the value for the estimated annualized remuneration. For example, if a person is paid $1,000 in week 1 and $1,500 in week 2, then his average remuneration is $1,250, which is then multiplied by 52 weeks to give us an estimated annual level of remuneration of $65,000. This is the amount which would be taxed in the progressive tax bands to get the total annual tax. Looking at the chart, we can see that there are 5 tax bands. Band 1 applies a tax of 0.5% on the value of remuneration earned up to $48,000 per fiscal year. Band 2 applies 9.25% on the next portion of remuneration earned between $48,000 and $1 up to $96,000. Band 3 is 10% on that portion of remuneration earned between $96,000 and $1 up to $200,000. Band 4 applies 11.5% on the value of remuneration earned between $200,000 and $1 up to $500,000. And finally, Band 5 applies 12.5% on remuneration earned between $500 and $1,000 up to the maximum taxable remuneration of $1 million. A further way of illustrating employee portion progressive tax bands is to imagine that each band was a bucket and we are filling up each bucket with remuneration shown as water. We know that each bucket would overflow if we tried to pour more water into it than the bucket can hold. The extra water would need to be put into the next bucket. This is how employee remuneration is taxed using progressive tax rates. Once a person exceeds the amount allowed in a bucket or band, then the rest of his salary would be taxed in the next bucket, and so forth. A person who earns $1 million will have portions of his remuneration taxed in each of the 5 bands. Notice that his remuneration would not only be taxed at the highest rate. Similarly, a person who earns $52,000 a year will be taxed in the first 2 bands, 0.5% on $48,000 and 9.25% on $4,000. The annual tax rate for this person would be $610, which is $240, the tax of 0.5% of $48,000 plus $370, the tax of 9.25% on $4,000. Pause here to consider how much your estimated annualized remuneration would be in order to determine how much of each of your dollars would fall within each band. The calculation of the annualized remuneration and the resultant annual tax is the first step in determining the amount of tax which must be withheld from a person's salary at each pay period. The next step is to divide the annual tax by the number of pay periods. We do this in order to determine how much to withhold from a person's salary or wage. For example, if the annual tax of a weekly paid employee is calculated to be $610, this number will be divided by 52 weeks. In this case, the tax to be withheld at the pay period is $11.73. To sum up the payroll tax calculation, just remember that 1. The employer portion of tax is a flat rate of tax applied to the business based on the total sum of remuneration paid to all employees and self-employed people. 2. The employee portion of tax is based on progressive tax rates applied to the remuneration paid to each person working in the business, including the self-employed person. And 3. Both portions are added together to make up the tax payment. If you would like to see a more detailed example of a payroll tax calculation, be sure to view Part 3 of this series.